As of Sunday, January 18, 2026, the stock market is currently closed for the weekend. BigBear.ai Holdings Inc., trading under the ticker symbol BBAI on the New York Stock Exchange, finished its last active trading session on Friday, January 16, 2026, at a price of $6.12 USD. This represented a slight intraday decline of 0.050 USD, or about 0.81%. Throughout that final session of the week, we saw the stock fluctuate between a high of 6.36 USD and a low of 6.04 USD. While a less than 1% drop might seem like a quiet day for a high beta stock like this one, the underlying story developing over the last few days suggests that the market is currently in a state of high-tension digestion. The immediate insight you need to grasp, which many casual observers are overlooking, is that BigBear.ai just executed a massive financial reset that fundamentally changes the risk profile of the company. Earlier this week, on January 14th, they announced the full conversion of $125 million in senior secured notes into common stock. This essentially wiped out the vast majority of their debt in one fell swoop, bringing their total note-related obligations down from $142 million to a mere $17 million. In the world of small-cap tech, this is the equivalent of a person paying off their mortgage and all their credit cards overnight. While this creates immediate dilution for current shareholders, it removes the bankruptcy boogeyman that has haunted this ticker since it came public. There is a significant gap between expectation and reality here. The general expectation from the retail crowd on social media is that BigBear.ai is just another speculative play riding the coattails of giants like Nvidia stock. Many people see the name and think it is a simple momentum play for those who missed the boat on the big caps. However, the reality is far more nuanced and, frankly, much more interesting from a structural standpoint. This is no longer a company just trying to survive until the next quarter. It is now a deleveraged entity with over $450 million in cash and investments. When you look at the balance sheet now, you see a current ratio of 3.13, meaning their liquid assets are more than triple their short-term obligations. This kind of liquidity is almost unheard of for a company with a market cap of around $2.7 billion that is still in its scaling phase. If you're using tools like Schwab Intelligent Portfolios or looking for online investment opportunities, you have likely noticed that BBAI has been one of the most volatile names in the sector. With a beta of 3.46, it moves over 3 times faster than the broader market. This volatility is exactly why institutional activity has been so mixed lately. We saw Cantor Fister recently downgrade the stock to a neutral rating with a $6 price target, even as other analysts at firms like H.C. Wainwright maintain a buy rating with targets as high as $8. The tension lies in the fact that while the balance sheet is pristine, the top-line revenue growth has been shaky. In the third quarter of 2025, revenue actually fell 20% year-over-year to about $33 million. This creates a fascinating conflict. The company is safer than ever financially, but its core business is currently undergoing a painful transition. Most of the recent trading volume, which has been averaging around 80 million shares a day, is being driven by this tug-of-war between the balance sheet bulls and the growth bears. The bulls point to the $376 million backlog as a sign of future prosperity, while the bears point to the downward revision of 2025 revenue guidance, which was lowered from a high of $180 million to a range of $125 to $140 million. This kind of guidance cut usually sends a stock into a tailspin, but the debt conversion has acted as a safety net. It's a rare situation where a company can miss on growth and still see its stock price hold relatively steady because the existential risk has been mitigated. Let's talk about what this company actually does to earn its keep. BigBear.ai operates at the intersection of national security and predictive analytics. They provide software that helps the U.S. Army, the Department of Homeland Security, and international intelligence agencies make sense of massive, messy data sets. Their most famous project is the Global Force Information Management System for the Army, which is designed to help military leaders see exactly how their forces are manned and equipped in real time. They also have a strong presence in airport security and facial recognition technology. A few days ago, they announced a partnership with the Kraft Group and the New England Patriots, which might seem like a PR stunt at first glance, but it actually signals an attempt to move their tech into the commercial world. They're working with International Forest Products Limited to improve supply chain transparency. If they can prove that their military-grade AI can solve the logistics headaches of a global shipping and manufacturing business, it opens up a much larger market than just government contracts. It's the same path Palantir took years ago, and we all know how that turned out for their long-term valuation. However, we have to address the elephant in the room, the valuation. BBAI is currently trading at roughly 16 times forward sales. To put that in perspective, many established software companies trade at half that multiple. For a company with negative revenue growth in recent quarters, that's a very rich price tag. Investors are essentially paying a premium for the possibility that the R1BBB, or the One Big Beautiful Bill, the massive government funding package for defense technology, will start hitting Big Bear's accounts in 2026. Management has explicitly stated that they expect this legislation to bring over $150 billion in supplemental funding to the Department of Defense for disruptive tech, and they believe they're sitting right in the center of that target. When you're looking at investing sites or using a fidelity trading platform, you have to decide if you believe management's narrative about a strategy shift. They recently acquired a company called Ask Sage, which is a generative AI platform built for highly regulated government environments. They expect this to bring in $25 million in annual recurring revenue. This is a big deal because recurring software revenue is much more valuable than one-off consulting contracts. If they can move from being a project-based company to a platform-based company, that 16x sales multiple might actually start to look reasonable. Comment below how many shares of BigBear.ai you currently hold, or if you're waiting for a dip back to the $5 level before buying in. I'm curious to see if you think the recent debt conversion is enough to offset the slowing revenue growth we saw in the last report. Institutional ownership currently sits at about 7.55%, which is quite low for a company of this size. This tells us that the smart money is still largely on the sidelines, waiting for proof of execution. We have seen some small buys from firms like NYSE Investment Advisors and Hans Financial Services, but the big whales are not here yet. This is both a risk and an opportunity. If BigBear.ai can show even 1/4 of positive revenue growth along with their new debt-free status, the institutional rush could be massive. On the other hand, if they continue to burn cash on research and development without a corresponding rise in sales, the retail investors who have been propping up the price might lose patience. Looking ahead to the rest of 2026, the catalysts are clear. We need to see how the partnership with the Kraft Group scales and whether the Ask Sage platform can actually hit that $25 million revenue target. We also need to watch for any new contracts stemming from the Department of Homeland Security, especially given the increased focus on border security and digital ID. The company has over $400 million to spend on acquisitions or internal growth, which gives them a lot of shots on goal. For those using a Robinhood app or SoFi Invest to manage their portfolio, it's easy to get caught up in the daily price swings. But with BBAI, you have to look at the long-term capital structure. By converting that debt, the company basically admitted that their previous financial model wasn't working and they needed a clean slate. they got it. Now the burden of proof is on CEO Kevin McAleenan to show that they can actually grow. If you look at Apple stock or Tesla stock, those companies had similar near-death experiences early on where they had to restructure to survive. I'm not saying Big Bear is the next Apple, but they have followed the playbook for a successful turnaround. The reality of the situation is that BigBear.ai is a much better company than it was 6 months ago, even if the stock price doesn't fully reflect that yet. They have cash, they have almost no debt, and they have a massive backlog of government work. The expectation of failure has been replaced by the expectation of execution. If they fail to deliver on that execution, the stock will likely fall back to the $4 range. But if they can leverage their new partnership with the Patriots and their generative AI platform to win even 2 or 3 major new contracts, the upside could be significant. In summary, we're looking at a company that has successfully navigated a financial minefield. The closing price of $6.12 reflects a market that is cautiously optimistic but still demands